Hi, thanks for checking out our website. By now you've probably already downloaded our tax-free retirement blueprint. If you haven't, there should be a download link in your email, or you can always go to our website at iPlanGroup.com and download it again. My name is Tim Dobronsky, and today I'm going to walk you through step by step our tax-free retirement blueprint. So let's go ahead and get started. Step one is to start a self-directed IRA, and you can start this with any IRA or a previous employer-sponsored plan, like a 401k plan, 403b, a 457, a thrift savings plan, or a TSP if you work for the post office, a defined benefit plan or a profit sharing plan. Any of these, as long as it's from a previous employer, that's the key here, you can roll those funds over to a self-directed IRA. If you're still currently working for a company and you have a 401k plan and you want to roll that over, you need to contact your plan administrator and see if that's going to be an option. A lot of times you cannot roll that over until you stop working for that employer. So once you transfer or roll over those funds to a self-directed IRA custodian of your choice, like iPlanGroup, then you can start purchasing real estate, mortgages, or any other non-traditional types of assets with your IRA funds. Another thing to consider is to look at converting your tax-deferred funds, if it's a traditional type of IRA or a 401k plan, to a Roth IRA. So you'd want to consult with your tax advisor to see if the numbers make sense here. But the advantage of this is you're taking a tax-deferred plan, you're paying taxes on it, so it is a taxable event. But then those funds are going to grow in that Roth IRA, completely tax-free for you for the rest of your life. And then on top of that, you're going to get to pass along that tax-free account to your beneficiaries. So it's really a great plan, a great estate planning tool, but you want to definitely talk to your tax advisor and also ask them about maybe if it would make sense to do a partial conversion. You don't have to do a full conversion and take that huge tax hit all at once. You can break it over the next couple of years and spread that tax hit out. So, take a look at that and ask your tax advisor about a Roth conversion. Step two then would be to choose your IRA investment vehicle. And with a self-directed IRA, you have almost unlimited options. I mean, you have things like real estate that you can invest in, privately held companies or small businesses, even precious metals like gold and silver is very popular right now. Privately held mortgages and deeds of trust is another investment that's very popular. And then even, buying and fixing up property that is in bad condition and needs a lot of work and TLC. You take a house like this here, you fix it up with your IRA funds, and then turn around and sell it for a profit. All those profits would go back into your IRA without it paying any capital gains taxes, back into your IRA, and it's either tax deferred or tax free depending on what type of account you have. So these are just some of the options, and we're going to take a little bit closer look at some of these investment options here and take a look and see what might be interesting and suit your needs and your goals here. So option number one would be to buy and hold rental real estate. There's a great rental market out there, and you can buy some pretty cheap houses and get some great deals on the houses out there and great cash flow as well. So buy and hold real estate is very popular, and some of the pros and cons of a buy and hold real estate. The pros here would be double-digit annual returns. Your IRA owns that property, so your IRA benefits from any appreciation that happens on that property, and then you get, of course, the monthly cash flow, which can be really nice right now, and then also non-recourse financing is available to increase your return. So there's a lot of pros and advantages that go into buy and hold real estate. And then some of the cons and some of the negatives to look at here would be your IRA is going to have to pay for any repair. So keep that in mind. Your IRA would cover any repair costs. Your IRA would also pay any property taxes, and you'd have to deal with any tenant headaches. So those are just some of the cons there with the buy and hold real estate. And then option one here is to find and manage your own deal. So you would do everything in option one here. You would research and contact, the top 10 REO agents in your area that you want to invest in. Then you would look at, approximately 50 to 100 properties and get estimate repairs on those properties and decide which properties you want to make an offer on. And usually, you whittle it down to about 10 or 20 properties. And then you would manage that property yourself. And so that would include marketing for tenants, screening the tenants, showing the properties, handling tenant complaints and repairs, collecting monthly rents, and even filing eviction notices. So some headaches there, but a lot of people like to do it themselves and be hands-on, and you can do that. And then option 2, for those of you who are like, no way, I do not want any of these headaches. I don't want to be fixing toilets and screening tenants. Option number 2 might be for you then. That would be to find the property, but then outsource the property management. So you could research and hire a licensed professional or property manager to manage that investment property. And then it's usually a licensed real estate agent. In the state of Ohio, I know you have to be a licensed agent in order to be a property manager. And then typically that property manager is going to charge you about 10% of the gross monthly rents collected. So, if it's a $600 monthly rent that you're bringing in, you're going to pay $60 a month for that property manager, but you're not going to have to deal with any of those headaches. So that's another option. And then, another option would be to buy from an experienced real estate investment company. So you could research a lot of turnkey real estate investment providers out there. Research in your area to narrow it down where you would like to invest. And then these turnkey real estate providers will handle everything for your IRA, including property acquisition, property financing, property renovation, and even the management. So they handle it all. It's completely turnkey, and you just need to put up the cash using your IRA funds, and they'll handle everything else. So it can be a pretty hands-free passive investment there for you. So that's another option to look at. Option number 2 would be to buy, fix, and flip real estate. So you can do this, and you could do this by taking a property like this and fixing it up, adding a little paint and lipstick to it, and then having it as a nice property ready to sell to either a retail buyer out there or maybe another investor looking for something that's already been fixed up and cash flowing. So this is another great opportunity out there. Some of the pros for buy, fix, and flip real estate would be larger returns than buying the hold strategy. Your annual returns could be as high as 30 to 50%. I've seen a lot of investors do that by flipping a couple properties each year, maybe do one a quarter, so you can do 4 houses a year, and you can get a really nice return on those. Your IRA does still own the property. You have no issues dealing with tenants because you're not renting the property out, and typically you only own the property for 90 to 120 days in the best case. So you want to fix that property up as quickly as possible and then flip it and make that profit and move on to the next one. Some of the cons here would be there is sometimes more risk. Some people would think because of the risk of not selling that property quick enough. There's no cash flow to offset some of those holding costs. So it really does make a huge difference in your profits on how quickly and how good you are at marketing the property to sell it. You also have to deal with the contractors because you can't do any of the work inside of your IRA. When an IRA owns the property, you can't personally do the work, so you're subcontracting that out to other contractors, and you're going to have to deal probably with some contractor issues. And then, of course, the possibility of not selling the property quick enough, which will eat into your profits as well. So those are a few of the cons. But some people really enjoy doing this and enjoy the before and the after of fixing up a property, taking a property that's beat up and really is in bad shape and in the worst house on a good street in a good neighborhood, and taking that and turning it around and seeing the after effects of your renovation and your design and really putting that neighborhood and building that neighborhood back up. And your neighbors really appreciate that as well. So option number 3 would be to invest in mortgage notes or deeds of trust in some states. And this is very popular, where you'll just own the piece of the paper. Basically, you're the bank, so your IRA is the bank and would own that mortgage. Now, some of the pros here would be that your IRA will receive a fixed rate of return of anywhere between 10 and 12% on average. It's secured by a first mortgage, so you are the bank. So if the borrower doesn't pay you, your IRA gets to foreclose on that property and would ultimately own that property. Your IRA can then sell or rent that property, and your IRA owns the note. So the deed not the deed on the property. So your IRA will not pay for any repairs or expenses, which is a huge benefit. You're really a passive investor here doing it this way. You don't have to worry about any of that. Repairs or expenses or managing properties here. Some of the cons would be that if your IRA forecloses on the property, you will have to pay an attorney fee to which is typically between $2,000 and $4,000 to foreclose on that property. And your IRA will not benefit from any appreciation on the property if you're just the lender or the bank on the property. So the homeowner would actually benefit from that appreciation. So, there's a few negatives there, but a lot of people like this option because it is so passive, and it is a nice return, and it's secured by real estate. So it's a pretty secure investment. Some of the things to be aware of when you're investing in mortgage notes would be to research local real estate investment companies before you invest with them and lend them the money. Do your due diligence on the property also being used as collateral. So look at comparable sales in the last 9 months. Usually look at comparable sales within a half a mile to a mile. You also are looking for similar bedrooms, bathrooms, square footage, etc. So you want to get a pretty apples to apples comparison there. And then do a walk through the property. Also look up the information on the county auditor's site, which is usually free online. And then, if you really want to be careful and do some really good due diligence, maybe order a professional appraisal. It might cost you $300 or $400, but you're having a professional do all this work for you, and you're going to get a nice appraisal back with a good appraised value there. That you could be pretty safe that your investment is secure by loaning under the appraised value. So maybe a loan usually around 70% loan to value or less. And also you could, if you want to go and save a little bit of money, you could do a broker's price opinion, a BPO, usually done by a real estate agent, and that would cost anywhere between $75 and $100. So definitely do your due diligence there. And then the last little note here and tip would be to close with a local title company or attorney, just to ensure that the mortgage is filed quickly and correctly with your local county, because this is really what's going to make your investment secure. If it's not filed properly or quickly enough, I have seen where investors have been burned doing it that way. But if you are dealing with a local title company or attorney, they should be able to handle that very professionally for you and make sure that your investment is secure. And then step 3 is to be aware and know the powers of compounding interest. And I'm sure most of you are familiar with this quote here by Albert Einstein, but the most powerful force in the universe is compound interest. And just to show you a few examples of that, I pulled up a few little calculators here and did a little calculation to show you the powers of compounding interest. And in this first example here, I took a principal balance of $5,000 and I didn't make any annual contributions, and I grew that investment for the next 30 years at a 15% annual rate of return. And I know you're saying, well, how can I get a 15% return? I can't get that in the stock market. You're probably right about that. But I've seen plenty of investors in real estate, especially, getting that type of return of 15, 20, 25%. It's not unheard of. You can do that. And so I took that 15%, I compounded it once annually, and you can see the calculation here after 30 years. Just by compounding the interest is $331,000. So off of a one-time $5,000 investment, as long as you can get that 15% return. So now let's take a look at the next example. Now the next example here, I took the same $5,000 principal. I did no annual contribution, and I grew it the same amount of time, 30 years. The only thing I changed here was the interest rate. So 20% instead of 15%. So you bump it up a little, 5% there, and you can see the numbers are crazy here. I mean, this is a future value of $1.1 million. So you've over tripled the amount of money you're going to have in that account by just getting an extra 5% return annually. So at 20%. So that's just showing you the powers of compounding interest here. And then on the last example, the only addition I made here was I made an annual contribution of $5,000. So, and I started with $5,000, same time period, 30 years, and that same return, which would be 20% a year. And you can see this calculation is unbelievable, $8 million. And if you do this type of investment, and combine the compounding interest with a Roth IRA, that would be completely tax-free. That would be over $8 million tax-free to you, your family, and your heirs when you pass. So the powers of compounding interest are definitely something to keep in mind here. And so, with compounding interest in mind, you repeat step 2 as often as possible with the principal and profits generated from those previous investments that you've made, and this will just accelerate the growth of your Roth IRA into those huge numbers that we just saw a moment ago. And another hint would be, again, to make your annual contributions like I made in the last example of $5,000 in a Roth or traditional IRA. If you're under 50, $6,000 if you're 50 or older. And then if you're self-employed, you can also make larger contributions, up to $17,000 by doing a Roth individual K plan if you're under age 50, or $22,500 if you're 50 or older. So just make sure you keep making those annual contributions, and then repeating step 2 as often as possible, and you will be shocked at how quickly that IRA and retirement account will grow for you. And now for the fourth and final step, to enjoy tax-free living. To do this, there's only 2 requirements you have to meet. Number 1, you must be at least 59 and a half years of age or older. And then number 2, your Roth IRA account must be established for at least 5 years. Once you meet both of these requirements, then it's time to start enjoying tax-free living with those you love. We all have our dream of what our retirement should look like. And now that you have a blueprint, it's time to create a plan and then execute that plan so your dream of retirement can become a reality. So contact us today to schedule your free IRA strategy session. Our IRA experts will help you map out the next steps you need to take to achieve your tax-free life. Thanks for joining us today. I hope you learned something, and we'll talk to you soon.